For the past few years, artificial intelligence has been presented as the biggest financial opportunity of this generation. In the United States especially, investors have been told that AI is not just another trend, but a complete transformation of the global economy. Companies like Nvidia, Microsoft, Google, and many emerging startups have become symbols of this new era. Stock prices have surged, headlines have exploded, and social media has created a powerful belief that AI is a guaranteed path to wealth. But in financial history, whenever something starts feeling too obvious, that is usually where the risk begins to build silently beneath the surface. The real question investors should be asking is not whether AI is important, but whether AI stocks are actually as safe as everyone believes right now. To understand this, we need to step back and look at how markets behave during major technological revolutions. Every major cycle in history follows a similar emotional pattern. First comes innovation, then excitement, then mass adoption of the narrative, and finally overconfidence. In the late 1990s, it was the internet. In the 2010s, it was smartphones and social media. Today, it is artificial intelligence. In every one of these cycles, investors began by focusing on real innovation, but eventually shifted towards speculation driven by fear of missing out. The same pattern is visible today in the AI sector. Companies are not just being valued based on earnings anymore, but based on how strongly they are connected to the AI story. And when narrative becomes more powerful than financial reality, markets often enter a dangerous phase of overpricing. Right now, many AI-related stocks are trading at extremely high valuations compared to their current earnings. This does not mean these companies are bad businesses. In fact, many of them are world-class leaders in technology. The problem is not the quality of the companies, but the expectations embedded in their stock prices. Investors are assuming perfect execution, unlimited growth, and very little competition in the future. But in real markets, perfection almost never exists. Even small disappointments in earnings or growth projections can lead to large corrections when expectations are too high. This is why some of the biggest risks in AI investing are not visible in the technology itself, but in the financial assumptions behind it. Another important factor that most retail investors overlook is competition. Right now, it may look like a few dominant players are controlling the AI space, but underneath the surface, a global race is unfolding. Large tech companies, startups, and even governments are investing heavily in artificial intelligence. This means innovation is spreading rapidly and competition is increasing at an even faster pace. When competition increases, pricing power usually decreases, and profit margins eventually come under pressure. What looks like a monopoly today can quickly turn into a highly competitive market tomorrow. And when that shift happens, stock prices often adjust much faster than investors expect. There is also a hidden cost structure behind AI that many people do not fully understand. Training and running advanced AI systems requires massive computing power, expensive hardware, large-scale data centers, and continuous energy consumption. These costs are extremely high and are still evolving. While revenues may grow, expenses are also growing alongside them. This creates uncertainty around long-term profitability. Investors often focus on the excitement of innovation, but ignore the economic reality of scaling it. At some point, markets will start asking whether these businesses can actually convert their rapid growth into sustainable profits, or whether they are simply burning capital to stay competitive. Another major factor that could influence AI stocks in the future is government regulation. In the United States and other major economies, policymakers are already discussing how to manage artificial intelligence in terms of safety, privacy, intellectual property, and employment impact. Whenever a technology becomes powerful enough to affect jobs and national systems, regulation is almost inevitable. Even before strict laws are implemented, the uncertainty itself can impact investor sentiment. Markets do not like unpredictability, and regulatory pressure often leads to slower growth expectations, which directly affects stock valuations. Beyond fundamentals, there is also a powerful psychological factor driving AI investments today. When a sector becomes popular, investors tend to move as a crowd rather than individuals. They start believing that every dip is a buying opportunity and that the trend will continue indefinitely. This creates a feedback loop where rising prices attract more buyers, and more buyers push prices even higher. Eventually, this kind of behavior disconnects stock prices from underlying reality. It is not driven by fraud or manipulation, but by collective optimism. However, history shows that when optimism becomes extreme, corrections are usually not gentle. This does not mean that artificial intelligence is a bad investment or that it will not change the world. On the contrary, AI is one of the most powerful technological shifts in modern history and will likely transform industries across the United States and the global economy. However, the stock market does not reward innovation alone. It rewards the price you pay for that innovation. A great company can still be a poor investment if bought at an inflated valuation. This is where many investors make mistakes, especially during hype cycles. The key lesson for investors is not to avoid AI, but to understand it with balance. Instead of asking whether AI is the future, the more important question is how much of that future is already priced into today's stock prices. Because in financial markets, the biggest risks are rarely found in obvious failures. They are usually found in moments of extreme confidence when everyone believes the outcome is guaranteed. And when expectations become too high, even good news can fail to move the market higher. In the end, artificial intelligence may define the future of technology, but the stock market will decide who actually profits from it. And in that difference between innovation and valuation lies the real opportunity and also the real risk for investors in today's AI-driven market.